I've been in business for over 30 years, and I can tell you one truth that most people refuse to accept. Most business deals are built on lies. Not illegal fraud necessarily, not always criminal deception, but lies nonetheless. Financial projections that are fantasy, cost estimates that ignore reality, revenue forecasts that require miracles. And the people selling these deals, they're not stupid. They know exactly what they're doing. I'm Jack Ma, and I built Alibaba from 18 people in my apartment into one of the largest companies in the world. And along the way, I've seen every trick, every deception, every manipulation that exists in business. Today, I'm going to teach you how to spot fraud before it costs you everything. How to read people who are lying to your face. How to see through financial games that are designed to separate you from your money. Because the difference between success and failure in business often comes down to one thing. Can you tell when someone is lying to you? Let me start with a story that taught me everything about deception in business. In 2003, when Alibaba was still struggling to survive, we were approached by a very well-known investment bank. They represented a company that wanted to partner with us. The deal looked incredible on paper. This company had impressive revenue, established market position, connections we desperately needed. The investment bankers spent 3 hours presenting to us beautiful slides, compelling numbers, a vision of how our partnership would dominate the Chinese internet market. But something bothered me. I couldn't put my finger on it at first. But something felt wrong. It wasn't what they were saying. It was what they weren't saying. They talked constantly about revenue growth, but they never mentioned profit margins. They showed us customer acquisition numbers, but they never discussed customer retention. They presented 5-year projections that showed exponential growth, but they didn't explain what specific actions would drive that growth. And most telling, they kept using phrases like industry standard multiples and comparable company valuations to justify their price. But they never wanted to discuss the actual cash flows of the business. I ask a simple question. If your projections are correct, and this business will be worth 10 times more in 5 years, why are you selling now instead of waiting? The answer I got was corporate speak, word salad, nothing of substance. That's when I knew this was a fraud. Not a criminal fraud, perhaps, but a business fraud. They were selling something they knew was overvalued, using projections they knew were unrealistic, at a price they knew we couldn't justify. We walked away from that deal. 6 months later, that company collapsed. The revenue they'd shown us was inflated through accounting tricks. The growth projections were fantasy. The whole thing was built on lies. That experience taught me something crucial. Fraudsters and deceivers don't usually make obvious mistakes. They're sophisticated. They know what investors want to hear, and they tell them exactly that. But they always give themselves away. Always. If you know what to look for. Let me teach you what to look for. The first sign of deception is when someone focuses on what could be instead of what is. Honest business people talk about reality, current customers, actual revenue, real margins, existing problems, and how they're solving them. Deceivers talk about potential, what the market could be, what revenue might reach, what margins should become once they achieve scale. The word potential is the favorite word of fraudsters. Let me give you an example. Early in my career, someone pitched to me an investment in an e-commerce platform. They spent 45 minutes telling me about the size of the internet market in China, the growth rate of online shopping, the number of potential customers. All of that was true. The market was huge. The growth was real. The potential was enormous. But when I asked how many customers they actually had, the answer was vague, growing rapidly. What does that mean? Rapidly from what to what? When I asked what their customer acquisition cost was, they said, "We're focused on growth right now. We'll optimize for profitability later." Translation: we're spending money we don't have to acquire, customers who don't stay, and we have no idea if the economics will ever work. This is the classic pattern. Talk about the size of the opportunity to distract from the weakness of the execution. The second sign of deception is complexity where simplicity should exist. Warren Buffett says if you can't explain a business in simple terms, you don't understand it. I agree completely. When I meet with business people, I always ask them to explain their business model in one sentence. How do you make money? Honest business people can answer this instantly. We sell products at a markup, we charge fees for services, we take a percentage of transactions. Simple. Deceivers make it complicated. They talk about ecosystem effects and network dynamics and multiple revenue streams and strategic optionality. Why? Because complexity hides problems. If you can't understand how they make money, you can't evaluate whether they actually will make money. I was once pitched an investment in a financial technology company. The CEO spent 30 minutes explaining their business model using terms like distributed ledger arbitrage and algorithmic market-making protocols. I stopped him and said, "Pretend I'm a child. How do you make money?" He couldn't answer. He went back to the jargon. He drew diagrams. He showed me technical specifications. But he couldn't explain in simple terms how money came in the door and why it would be more than the money going out. That told me everything. He either didn't understand his own business, or he was deliberately making it confusing to hide that it didn't work. Either way, I'm not investing. The third sign of deception is when someone tells you why the normal rules don't apply to them. Every business is subject to certain realities. Competition exists. Customers have alternatives. Profit margins face pressure. Growth requires capital. These are not optional. These are laws of business as reliable as laws of physics. But deceivers always have an explanation for why these laws don't apply to their business. Their business is different. Their technology is proprietary. Their network effects create a moat. Their first mover advantage is insurmountable. Maybe, but probably not. I've seen countless businesses claim they had proprietary technology that was easily replicated, network effects that disappeared as soon as someone offered better service, first mover advantages that became first mover disadvantages when the market shifted. The default assumption should be that normal business rules apply. Competition will emerge, margins will compress, growth will slow. If someone's telling you their business is immune to these forces, they're either delusional or dishonest. Either way, don't give them your money. The fourth sign of deception is misalignment between words and actions. This is subtle but incredibly revealing. Pay attention to what business people do, not what they say. If a CEO says the business is undervalued but he's selling stock, believe the selling, not the words. If a company says they're focused on long-term value creation but they're using accounting tricks to inflate short-term earnings, believe the actions, not the strategy presentation. If an entrepreneur says he's fully committed to the business but he's negotiating to sell it before it's even profitable, believe the negotiation, not the commitment speech. People lie with words all the time. They rarely lie with actions because actions have consequences. Let me share a story that illustrates this perfectly. In 2007, I was approached by an entrepreneur who wanted me to invest in his company. He gave an impassioned presentation about his vision, his commitment, his belief in the mission. He said he was building this company for the long term, 10 years minimum. He wanted to create something that would last. Very inspiring. But then I looked at the proposed term sheet. He wanted to structure the deal so he could sell his shares after just 2 years. I asked him about this. Why do you need liquidity in 2 years if you committed for 10? His answer was all about maintaining flexibility, personal financial planning, estate considerations, all reasonable sounding justifications. But the truth was obvious. His actions revealed that he wanted an exit in 2 years, regardless of what his words said about long-term commitment. I didn't invest. A year and a half later, he sold the company to a bigger player, cashed out, and moved on to his next venture. His words lied. His actions told the truth. The fifth sign of deception is when numbers don't reconcile with reality. This is where you need to do actual analysis. You can't just listen to the story. You have to verify the numbers make sense. I once reviewed a investment opportunity in a manufacturing business. The projections show revenue growing from $50 million to $200 million over 5 years. Impressive growth. But when I looked at the details, it didn't make sense. They were projecting to quadruple revenue while only doubling production capacity. How? Either they were going to dramatically raise prices, which would probably reduce volume, or they were going to increase utilization and efficiency. I asked which one. They said both. Prices would go up 20%, and efficiency would improve 50%. I asked if they had contracts supporting the price increases. No. I asked if they had specific plans for the efficiency improvements. Vague references to best practices and process optimization. So the entire growth plan was based on assumptions that had no supporting evidence. That's a red flag. When growth projections rely on multiple optimistic assumptions all working out perfectly, it's probably fantasy. The sixth sign of deception is the use of adjusted metrics. This is rampant in modern business, and it drives me crazy. A company will report their results, but then they'll present adjusted results that remove all the bad stuff. Adjusted EBITDA, non-GAAP earnings, normalized revenue, underlying profit. Every adjustment makes the numbers look better. Funny how that works. Let me be clear. Sometimes adjustments are legitimate. If you sold a building and that's a one-time gain, it makes sense to show what earnings look like without it. But when companies are consistently adjusting their numbers, when there are 5 different adjustments every quarter, when the adjusted number is dramatically different from the actual number, you're being deceived. I saw a company recently that reported a GAAP loss of $50 million, but an adjusted profit of $20 million. $17 million of adjustments. What were they adjusting for? Stock-based compensation, acquisition-related amortization, restructuring charges, litigation expenses, and something called business optimization costs. In other words, they adjusted out every actual expense they didn't want investors to focus on. That's not transparency. That's deception. If a business can't show you real profit using standard accounting rules, they're not profitable. Don't let them convince you otherwise with their adjusted metrics. The seventh sign of deception is when someone is too eager to make the deal happen. Desperation smells, and it should make you suspicious. If a business opportunity is as good as they claim, why are they so eager to give you a piece of it? Why aren't they keeping it for themselves? The best deals I've ever done, the sellers weren't desperate. They were successful people with good businesses who were open to partnership if the terms made sense, but they didn't need to sell. The worst deals I've seen have all involved sellers who were pushing hard to close quickly, who offered sweeteners and concessions to make it happen, who created artificial urgency about why it needed to happen now. That urgency is almost always because they know something you don't. Maybe the market is about to shift. Maybe competition is about to emerge. Maybe their key employee is about to leave. Maybe their technology is about to become obsolete. Whatever it is, they want to close the deal before you figure it out. So when someone is pushing you to move fast, slow down. When they're offering concessions, ask why. When they're creating urgency, investigate what they're not telling you. The eighth sign of deception is credentials used as credibility. This is a favorite trick of sophisticated fraudsters. They'll tell you about their Harvard MBA, their previous success at Goldman Sachs, their advisory board full of impressive names, their investors who are well-known institutions. All of this is designed to make you think these are smart, successful, connected people. They must know what they're doing. But credentials and connections don't equal honesty or competence. I've seen Harvard MBAs run companies into the ground. I've seen Goldman Sachs alumni structure deals that enrich them while destroying investor value. I've seen impressive advisory boards that never actually advised on anything. And well-known institutions make bad investments all the time. Their presence doesn't validate the opportunity. What validates an opportunity is whether the business model makes sense, whether the numbers are real, whether the people are honest, and whether the price is fair. Credentials are irrelevant to those questions. In fact, I'm often more suspicious when someone leads with their credentials because it suggests they're trying to sell you on who they are instead of what they're offering. The substance should speak for itself. If it doesn't, the resume won't fix that. The ninth sign of deception is accounting that creates earnings out of thin air. Let me tell you about the most common accounting frauds I've seen, because these are still happening all the time. Revenue recognition fraud. This is when a company books revenue before they've actually earned it. Maybe they ship products that customers haven't agreed to buy and book them as sales. Maybe they recognize 5 years of subscription revenue up front. Maybe they book revenue from barter transactions at inflated values. All of this makes revenue look higher than it really is. Reserve manipulation. This is common in insurance and banking. Companies can manipulate their reserves for losses to make profits look better. Need better earnings this quarter? Just reduce the reserves. The losses will show up later, but you've bought yourself time. Capitalization fraud. This is when companies take expenses that should be recorded immediately and instead capitalize them as assets that get depreciated over years. This makes current profits look higher even though the economic reality hasn't changed. Off-balance sheet fraud. This is when liabilities are hidden through special purpose entities or other structures that keep them off the main financial statements. The company looks healthier than it is because you're not seeing all the debt. Channel stuffing. This is when companies pressure their distributors or retailers to buy more inventory than they can sell, booking it as revenue even though it will just come back as returns later. I've seen all of these multiple times at companies of all sizes. How do you spot them? You have to actually read the financial statements, not just the highlights, the whole thing, including the footnotes. That's where the truth hides. In the footnotes and the management discussion sections, you'll find the explanations of accounting policies, the descriptions of one-time items, the risks that management is required to disclose. Most investors never read these sections. Fraudsters know this, so they bury the truth there, knowing it probably won't be found. But if you read carefully, you'll see phrases like revenue recognition policies differ from industry standards, or significant judgment is required in estimating reserves, or certain assets are valued using management estimates rather than market prices. These phrases are warnings. They're telling you that the numbers might not be what they seem. The 10th sign of deception is when the business model requires perfect execution of multiple unlikely events. Let me explain what I mean. Some business plans are basically if A happens and B happens and C happens and D happens, then we'll be hugely successful. But A has a 50% chance of happening. B has a 60% chance. C has a 40% chance. D has a 70% chance. So the overall probability of success is 0.5 times, 0.6 times, 0.4 times, 0.7, which equals 8.4%, less than 1 in 10. But the person pitching you won't present it that way. They'll present each piece as likely or reasonable, and they'll gloss over the fact that all of them need to happen together. I was pitched an investment in a retail business that required successfully negotiating leases in prime locations at below market rates, hiring experienced retail managers in a tight labor market, launching a marketing campaign that would drive foot traffic despite no brand recognition, achieving inventory turns that were better than established competitors, and maintaining gross margins that the industry hadn't seen in a decade. Any one of these might be achievable, but all of them together, extremely unlikely. Yet the financial projections assumed all of them would happen exactly as planned. That's not a business plan. That's a wish list. Honest business people present plans that could succeed even if some things go wrong. They build in margin for error. They show you the downside scenarios, not just the upside. Deceivers present plans that only work if everything goes perfectly, and then they're surprised when reality intervenes. Now, let me share some specific techniques I use to evaluate whether someone is being honest with me. First, I ask unexpected questions. Deceivers prepare for the obvious questions. They have smooth answers for questions about revenue, growth, competition, advantage. But if you ask something they haven't prepared for, they have to think on their feet. And that's when truth emerges. I'll ask, what's the biggest mistake you've made in this business and what did you learn from it? Honest people will tell you real mistakes and real lessons. Deceivers will give you a humble brag answer about how they care too much or work too hard. I'll ask, which of your assumptions are you most worried about being wrong? Honest people have thought about this and will give you specific answers. Deceivers will say they're confident in all their assumptions, or they'll give you a generic answer that doesn't reveal actual vulnerability. I'll ask, if you were trying to put this company out of business, how would you do it? This forces them to think about their real weaknesses. Honest people will identify genuine vulnerabilities. Deceivers will struggle because they've been focused on selling the story, not examining the risks. Second, I test their knowledge of details. It's easy to know the high-level story. It's hard to know the operational details. So I ask about details. What's your customer acquisition cost broken down by channel? What's your gross margin on your top 3 products? What's your retention rate by cohort? What percentage of revenue comes from your top 10 customers? If they know these numbers code, they're running the business. If they don't know, or they have to look them up, or they give you approximations, they're either not involved enough or they're not being honest. Third, I watch their body language and energy when discussing different topics. People get animated about things they care about and believe in. They get defensive or evasive about things they're hiding. Watch what happens when you question their projections. Do they eagerly explain their reasoning, or do they get irritated that you're challenging them? Watch what happens when you ask about past failures or mistakes. Do they openly discuss what went wrong, or do they deflect and change the subject? Watch what happens when you ask to speak with customers or employees. Do they facilitate it, or do they give you reasons why that would be difficult? These reactions tell you a lot. Fourth, I verify everything they tell me independently. Trust. But verify, actually, in business, don't even trust. Just verify. If they tell me they have 100 enterprise customers, I want to see the list and I want to talk to some of them. If they tell me they're growing revenue 30% annually, I want to see monthly numbers for the past 3 years, not just annual summaries. If they tell me they have a competitive advantage based on proprietary technology, I want technical people to evaluate whether it's actually proprietary and whether it actually matters. Never take anyone's word for anything important. Always verify. Fifth, I look for consistency over time. One of the best ways to spot deception is to compare what someone says today with what they said 6 months ago or a year ago. If the story keeps changing, if the priorities keep shifting, if the metrics they emphasize keep rotating, something is wrong. Honest businesses have consistent strategies and consistent messages because they are based on consistent realities. Deceivers change their story based on what they think will sell best at any given moment. Let me share one more story that brings all of this together. In 2006, Alibaba was approached by a private equity firm that wanted to invest $500 million. This was a significant amount of money for us at that time, and the terms they offered seemed generous. But during the due diligence process, I noticed something strange. They kept asking about our accounting policies in ways that suggested they wanted us to change them. They suggested we could recognize revenue earlier in the transaction cycle. They suggested we could capitalize certain expenses instead of expensing them. They suggested we could use different assumptions for calculating reserves. Each suggestion would have made our reported earnings higher, but none of them would have changed the actual economic reality of our business. I asked them directly, why do you want us to change our accounting? The answer was revealing. They said their fund needed to show strong returns to their limited partners, and having us report higher earnings would help justify a higher valuation for their stake. In other words, they wanted us to manipulate our accounting to make their investment look better, regardless of whether it reflected reality. I told them no. We would continue using conservative accounting that we believed accurately reflected our business. If that meant our reported earnings were lower, so be it. They withdrew their investment offer, but you know what? That decision to maintain honest accounting served us incredibly well. When we eventually went public in 2014, investors trusted our numbers because we had a history of conservative, transparent reporting. The integrity we maintained was worth far more than the $500 million we gave up. That's the ultimate lesson about deception in business. Short-term gains from dishonesty almost always lead to long-term destruction of value and trust. The people who succeed in business long-term are not the cleverest deceivers. They are the most consistently honest because trust is the foundation of all business. Without it, you might make money once, but you'll never build anything that lasts. When I started Alibaba, I made a commitment to our team. We would never lie to customers. We would never manipulate our numbers. We would never make promises we couldn't keep. Was this sometimes disadvantageous in the short term? Yes. There were deals we lost because we wouldn't exaggerate our capabilities. There were investors who passed because our conservative projections weren't exciting enough. But over time, our reputation for honesty became our greatest asset. Customers trusted us, partners trusted us, investors trusted us, employees trusted us, and that trust allowed us to build something that lasted and grew beyond anything we initially imagined. So, my advice to anyone in business, whether you're investing, partnering, buying, or selling, is simple. Demand honesty from others and from yourself. Don't accept complexity when simplicity should exist. Don't accept projections without supporting logic. Don't accept adjusted metrics that hide reality. Don't accept credentials as a substitute for substance. Ask hard questions. Verify independently. Watch actions more than words. Read the fine print. And most importantly, trust your instincts. If something feels wrong, it probably is. If someone's story doesn't make sense, there's probably a reason. The frauds and deceptions I've described aren't rare exceptions. They're common. They're everywhere. They're probably in opportunities you're evaluating right now. But they can be spotted. They can be avoided. If you know what to look for and you have the discipline to walk away when you see them, because the best investment you can make is the investment you don't make in a fraud.